Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwinn, head of front-end rate strategy in the Americas, and Theo Chapsalis, head of UK rate strategy. This week, there's been little else to talk about really other than the US election. It felt like a very long week waiting for that result to come out, and it feels like we finally got there this weekend. So without further ado, I will pass straight on to you, Blake, to give us your updated thoughts on those US election results.
Thanks, Imogen. Yeah, what a week. I mean, it's nuts thinking about it now. We actually had a Fed meeting and a Treasury refunding announcement all last week, which in their own right, any other time would have been huge market events, and nobody even knew this they happened. It was, all consuming watching the election results continue to tick in. So where we're at right now, I mean, it looks like we're pretty much headed to a split government. We still have two runoff races, Senate races in Georgia. Those are going to be January 5th. If Democrats do manage to take both of those races, we would be heading to a 50-50 Senate, in which case Vice President Harris would serve as a tiebreak, meaning Democrats would be in charge. They'd get to put their own party members in charge of most of the committees, kind of set the agenda, call things for a vote. So it does give them a fair amount of power if they were to take those two elections in Georgia. But at this case, that doesn't really seem like the most probable outcome. If you kind of just replay the election results from last week, rerun them with only the two leading candidates in each of those Senate races, it still looks like the Republicans have enough votes. You kind of wrap in Libertarian got a few votes in one of the races, and there were also a lot of other kind of conservative candidates that were splitting the vote in the special election. So if you kind of assume that all those votes migrate towards the Republican, it would seem more likely that they take both of those races, but there's going to be a lot of cross currents. Dynamics can change a lot. I probably put, I'd say around 20-25% odds on Democrats taking both of those seats, meaning that it does look like kind of an overwhelming probability at this point that we are headed to some type of split government. I think the interesting thing is that prior to the election, we had really seen this as the worst outcome for risk. We saw it as a meaningful flattener for the U.S. Treasury curve. Really thought rates were going to rally on this. The curve was going to flatten, but that really isn't what's happened. I mean, things are a little bit cluttered today because of the vaccine news, so we're starting to get some market reaction to that. But if we could just isolate what happened after the election, overall, it really wasn't as negative as expected. The Treasury curve did indeed flatten a little bit, but it was very modest. I mean, we basically just traded back to levels that we were at in mid-October prior to the election. And if you look at kind of inflation expectations, they came off slightly, which is to be expected, but much, much less than I personally would have foreseen. I thought this would have been a kind of a big catalyst. The split government would have been a big catalyst for things to reprice a little. I think the biggest surprise, though, is probably the equity market reaction, as they didn't even see that temporary or small backup. They basically continued to rally entirely through the election. So this was certainly, I think, a bit surprising to me. I think probably to a lot of market participants. Trying to think of why they didn't react as we expected. It's possible that this is just a broad relief that the election is finally behind us. Investors were kind of holding back into the election. We did hear this as a theme a lot heading into it, that investors were staying very neutral. We talked about that in some of our prior podcasts, and that maybe now that the election's passed, it's out of the way. Doesn't really matter per se what the outcome was, as long as it wasn't, a big market shock. Investors are now feeling more comfortable to kind of re-engage with the markets. Perhaps you've got a little bit of enthusiasm still on the potential for a blue wave light. If Democrats are able to take these Georgia Senate races, we aren't completely sure that we're getting a split government yet. So maybe there's a little optimism on that. Or perhaps, we were just underweighting the value that markets were placing on what's, I think, everyone would probably argue is going to be a less volatile administration. So I think you kind of take all those things on board, and we just haven't seen the market reaction that we expected. So I think going forward from here, I think the attention's obviously going to shift to COVID, and vaccine news is the primary curve and rates driver now that, we've kind of got the election in the rearview mirror. At this point, it doesn't really seem like, the election panned out to be this kind of big, market moving event. And I think looking forward, even as we, see these Trump court challenges start to fade, and you get these Georgia results, I don't expect this to be a really big market mover. You've kind of had the upside tail risk clipped by Democratic underperformance, meaning that, even if they take these 2 Georgia Senate seats, they're governing with a very, very thin majority in the Senate just on the tiebreak, meaning they're going to have to scale back any kind of plans they had for fiscal stimulus. They're probably not going to get anything done on tax hikes. If they wanted to increase regulation through legislation, that's probably off the table at this point. So really everything that people were kind of planning on in this very strong Dem sweep is off the table. So you kind of clip that upside risk there. And then on the downside, it just doesn't seem, given what we've seen the last few days, it doesn't seem that markets really care about a split government as much as we thought they would. So even going forward, it seems like we're really shifting into a mode now where COVID and vaccines are going to be the major driver of markets.
Okay, so one of the big market reactions that we were talking about, before the election was this steepener, and part of that was driven by our expectations of a Biden win and a Democrat sweep, and or a kind of green light towards big fiscal stimulus. Clearly that's, or potentially with only a 25% chance of Democrats taking the Senate, that's kind of off the table now. So what is your expectation for fiscal stimulus for next year?
Oh yeah, and even still, I mean, look, even that 20-25% outcome, that still doesn't get you the kind of stimulus that we had kind of expected prior to the election, where we thought Dems were going to come in, with a larger majority in the Senate. They were going to come in with this kind of mandate to enact a lot of Biden's agenda. And the fact that it's so close, and the fact that they underperformed in a lot of these state races, just means that all that kind of cachet and that power to get a lot done on the fiscal side is really gone. Even when, as I said, even if they kind of eke out this 50-50 split in the Senate somehow, you basically have to have a party line vote on every issue that's put forward to get that 50. And there are a lot of centrist Democrats, in Senate that have to worry about reelection. They have to, worry about kind of being painted with the farther left factions of the Democratic Party, and they're going to be very wary about voting for big fiscal stimulus or environmental spending or any kind of tax hikes, as I said. So enforcing discipline to get all 50 of them to vote for a lot of this stuff is going to be difficult, meaning that, something like $3 trillion, that had been something I had been thinking about. If they had come in with a very strong victory and a big majority in the Senate, I think they could have gone back to that HEROES Act that they talked about 5 or 6 months ago. That was $3 trillion. That's off the table. Even if they managed to take these, we'd still be talking about something around $2 trillion. If they don't manage to take those Senate races, I mean, it could be as low as $500 billion or even nothing. If McConnell is in charge of the Senate and really wants to prevent these things from moving forward, he has the power to do that. He has the power to kind of stop progress on any of these things. And if anything, some of the positive economic news, we got a good NFP print last Friday. That kind of gives him a little bit more ammo to say, hey, we don't really need big fiscal stimulus. So, if they do end up split, we could be talking about nothing.
So where does that leave the balance between kind of fiscal and monetary policy? One of the big themes globally has been the shift towards fiscal dominance and away from monetary dominance. Is this the end of fiscal policy now? Do we have to see monetary policy coming back to play in a big way in the US? Or?
Yeah, I mean, I think in a way it's going to be, it's really possible that we see vaccine news or developments actually bail out on the fiscal side, because I think heading into this year, if McConnell's in charge and they really want to they kind of approach this like they did the Obama administration, where it's really about kind of stopping any kind of progress from being made to hopefully swing back the midterm elections. If you're in that kind of scenario, you're not getting any fiscal tailwinds. So it's tough to say fiscal dominance is the big theme if you're really not getting anything on the fiscal side. But I think in some ways you end up there not by choice or not by anything done on Congress or on Biden's behalf, but because monetary policy side at this point is looking a little light on the toolbox. As much as they'll protest to the opposite. I mean, you've kind of seen in a lot of the Fed speak that's come out, how much questions about how much more asset purchases are really going to do. They don't want to take rates negative. I mean, extending forward guidance, these things aren't really going to do a whole lot to boost economic activity at this point. And so I think, they're really kind of hoping on the fiscal side. And if we don't get anything there, I don't know that monetary policy is going to be able to provide a whole lot more.
Okay, makes sense. So, Giles, it felt like in Europe last week, certainly we were all a bit paralyzed by the US elections, and the market couldn't focus on anything else despite it being in the US and not Europe. And one thing we've been arguing, well, I guess with particular reference to Italy, is this theme of the political backdrop actually being much more benign in Europe now, and populist parties have been kind of losing ground in the polls. And I guess that theme was kind of reaffirmed over the weekend with Trump's loss. So how are we thinking about core rates from here? I guess that kind of uncertainty out of the way, plus today being Monday, news on the COVID vaccine front, it should all play pretty nicely for our bearish core rates view, shouldn't it?
Yeah, well, the first thing I'll say is after that high octane download from Blake, I sort of feel like I need to take a big deep breath. I mean, on Donald Trump and and his departure, I think that is a pretty unambiguous positive for sentiment about European politics. It's bound to be. I think one of the things that we've been saying a lot over the course of this year is that one of the surprises is that populism has been in retreat, and this really is just yet another manifestation of that. But it's a particularly important one because Donald Trump had a strategic focus on undermining, I suppose, the EU, and in many different ways. And it's just going to be much harder, I think, for populists who might try to use that sort of anti-EU rhetoric really to get any traction. And as I say, this is the continuation of a theme, but it should be positive, I think, for European, I suppose, sentiment generally, but in particular, obviously, for peripheral issuers and so on. With regard to where it leaves us for rates overall, yeah, I think that does feed into the bearish view, as in rates higher view quite nicely. Good. What's good for risk tends to push in that direction, and obviously the US elections were big and important, but really what's been hanging over Europe for the last couple of months, above all, has been the terrible COVID headlines, and the real sense of pessimism that's been coming from that. And last week, for the first time, we really sort of felt like we could see an improvement in some of the trends, a little bit tentative, but in some countries, but really quite clear in others. For example, in Ireland and Belgium, those were two where it was really quite obvious. This is something we're looking at very carefully. And, it does feel like that improvement is building. And that was before we had this news this morning from Pfizer with its very encouraging results on efficacy for its vaccine. So overall, I think, we've got a few themes here which appear to be coming together quite nicely for our bearish rates view.
Well, so all is working finally. So just stick, I guess, for now with the theme of politics, the US election, and quickly, if I just go to you, Theo, because it's also turning out to be a critical few weeks for Brexit. How much of a bearing do you think that the US election may well have now on Brexit, and what are our latest thoughts on the UK situation?
Yeah, I think the UK is a market which was predominantly driven by politics. 2019 was definitely a year dominated by UK politics, and this is everything that has affected the gilts market. The coming weeks are definitely critical. There are high expectations in the market, with most market participants expecting a deal to be fleshed out in the next 2 to 3 weeks. Clearly, this has got implications both for the fixed income, higher yields, potentially steeper curve, but it's primarily a sell the 10-year sector if this is to happen. I think, and the other aspect is really the the implication for inflation that the market, as things stand, is expecting is fearful of hyperinflation to kick in because of some sort of disruption in Brexit. But if we do have a deal, this obviously takes out this premium from the front end of the curve. So it has implications both for rates and for inflation. I think this is the political side. What the market will have definitely to figure out, and we will have to do that ourselves, is to find out how deep the integration will be between the UK and the EU in the future relationship. Because the underlying assumption is that it will be a very skinny deal, and this is what everybody largely expects, which means that there will be a disruption, and this disruption will have implications again for fixed income. However, I think the risk is if the deal is not that bad and not so disruptive, and this will be key. So this potentially could provide, and support to the risk on sentiment that we have in the UK. So this is on the politics side. I think the other topic that we definitely need to discuss is policy. And this would be monetary policy, for example, and fiscal policy, right? So on the monetary policy, we had pretty much the BOE announcing 150 billion of QE last week, which by itself, it may seem like a huge number. And it is a huge number, but the pace will be the same as what we had this year. At the same time, fiscal policy is here, and we expect at least around 30 billion of additional spending as part of the furlough schemes. So monetary and fiscal policy, they will have to go hand in hand together in 2021. And well, the difference of those, the difference in the pace of those will largely define the direction and the move in yields.
So given our kind of base case Brexit scenario, do we expect more from the Bank of England next year, or do you think now that we had that slightly more dovish than expected reaction last week, that's as much as we're going to get from them over our kind of forecast horizon?
So we think that the Bank of England has got more ammunition, and this is a very good point that you bring up. And in fact, it has been called into question recently that the Bank of England is reaching the limits of their QE abilities, but we are very far from there. As things stand, the Bank of England could implement at least another 300 billion of QE without changing any of the constraints. So we are far from that. We think that next year more QE is coming, and we think that, well, the deficit will have to stay high, and fiscal policy will have to be supported by monetary policy. So we do expect the two to go together, and we do expect an increase in the stock of QE next year. In fact, the Bank of England, they have said that they are ready to increase the pace of QE, which implicitly means also that the stock of QE will also have to be increased, given that the current pace is similar to the previous pace.
Okay, so let's stick with policy for a minute then, because I think in Europe, we've also been having a really interesting discussion over the last few weeks about, future policy expansion. We had a really dovish ECB meeting last week where Lagarde pretty much pre-committed to, recalibrating policy in December. And then since we've had Schnabel, who, we place quite high importance on what she says, but also generally think of her as relatively dovish, almost walk back a little bit on those expectations and argue, well, really against a rate cut and against significant QE expansion, I would say, at risk of further flattening the curve. And with, Giles, we've had a generally more optimistic view on COVID trends than I would say headlines have been sort of portraying, and also now we have more positive news on the vaccine front, seemingly just as of today. So what are we thinking about the future kind of policy moves from the ECB heading into December, when we have this key recalibration meeting, if you like?
I think you've said it all, to be honest with you. I mean, yeah, it was an important speech, I think, last week from Isabel Schnabel. And, she was pretty explicit about being, her concerns about whether we are close to this reversal rate, which is this idea that, once you cut rates to a certain level, it actually starts becoming counterproductive to try to reduce them further. And she was pretty explicit about her concerns about anything which flattens the curve. And the ECB has done quite a lot of work that shows actually they think that rate cuts flatten the curve as much, or if not more, than quantitative easing itself. So I think that the first conclusion is that they're probably not thinking about rate cuts for December. At least within a framework where they'll be thinking about everything, I think that's probably low likelihood. Let's put it that way. I think the markets have been taking that on board a little bit, but they still have rate cuts priced in quite a big way over the course of next year. And I do think that if the ECB passes again on cutting rates in December, the question of if not now, then when is an important and relevant one. So I think that could well be a risk for markets. With regard to quantitative easing, we do expect them to extend QE, and I think that's probably pretty much consensus. They've probably got some reconfiguration to do of how much is in the sort of super flexible PEP bucket versus the less flexible QE, sort of traditional QE version. Overall, I don't think that we're expecting any big changes to the way that they are actually going to be conducting themselves in the market in the foreseeable future, though.
And do you think that is against market expectations? I know the market moved pretty quickly last Thursday to price in, probably around the 30 to 40.
I think it's a little bit negative, I think, for duration, and so that's another of the sort of bearish stories that I think is in the mix for us. Certainly something that's worth keeping in mind. One of the things that we've been talking about quite a bit today is, it's been really strong risk on, but some periphery hasn't been doing quite as well in terms of spreads as you might have expected in those circumstances. And that might be partly to do with people just pulling back a little bit on how much they think the ECB is going to deliver in terms of QE. But I think that's just putting the cart before the horse, to be honest with you. What would you prefer? A bit of macro stabilization, or the ECB to be doing a little bit more? I think it's pretty clear for me. So I think that probably should. Well, I think that will come right.
All right, great. Well, thanks everyone for joining. It sounds like we've got a busy week ahead, and we of course will be watching COVID trends very closely, particularly here in Europe, and any more news of a vaccine which could help steer markets in the direction that we've been calling for the past few weeks. Thank you.
I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.